Today, why the housing bulls are wrong. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed post covering finance and property news with a distinctively Australian flavour. Just a quick reminder that tonight at 8 p.m. Sydney time, I will be broadcasting my last live stream from Australia. So join us for the latest on property and finance, and particularly mortgage stress and the housing situation, but also to talk more broadly about what we've learnt and what's ahead. But as a precursor to that, sometimes it's quite useful to stand back and look at another market, because we get quite caught up with what's happening locally. And in fact, the RBC Canadian Housing Market Report, which has just come out, is worthy of consideration. They say the Canadian housing market correction has yet to run its course, but it's gradually letting up. So they think activity will hit bottom sometime in the spring. That's the northern spring, of course. Prices will level out a few months later, provided the Bank of Canada is done raising interest rates. All told, their forecasts are for a 15% peak to trough decline in the National Home Price Index. Roughly half of that is still to come. And then they say what happens next will disappoint housing bulls. We see the recovery phase starting slowly later this year as affordability issues and a weaker economy continues to hold back buyers. The pace should progressively pick up in 2024 once the economy clears its soft patch, inflation returns to target, and the Bank of Canada reverses part of its massive rate increases it's imposed since March 2020. Booming immigration will fuel demand through the medium term and possibly beyond, raising the odds of deep supply shortages in the future if home building fails to pick up materially. A precipitous slide in home resales has ended a 2-year market frenzy that kicked off in March 2020, but this slowdown has significantly moderated since the fall. The primary reason is activity has now deeply been depressed in most markets, and unless the economy craters, which isn't their base case, there's little downside left. Accounting for the growth in housing stock, nationwide resales are the quietest that they've been since the 2008-2009 global financial crisis, excluding the lockdown period in the spring of 2020. And they believe a bottom will form in the coming months. Some markets might be ahead of the pack, like Ontario and possibly Atlantic Canada, while others, for example the Prairies and Quebec, might lag somewhat. And there's another reason the Bank of Canada's rate hiking cycle is now likely on hold, they say. They think January's 25 basis point hike will be the final strike in a historic campaign that drove the policy rate up by a staggering 425 basis points, taking it to 4.5% in less than a year. Market sentiment should get a boost when participants come to that conclusion. Any downward drift in longer-term bond yields, which is RBC's call over the next year, is also likely to be viewed as a positive sign of a turnaround. But these factors will help stabilise the market, not prop it up. And they see the interest rate environment remaining restrictive for a while, and the Bank of Canada abstaining from cutting rates until 2024. So that means the sharp deterioration in housing affordability that's happened since 2021 won't unwind quickly. Buyers will continue to face steep challenges, especially in British Columbia, Ontario, and other expensive markets where ownership costs have ballooned during the pandemic. Lingering affordability issues will stand in the way of a quick market rebound and a material easing in buyers' budget constraints. And they expect home prices to continue declining in the coming months as a result. The National House Price Index is likely to fall by another 8% by the third quarter from fourth quarter levels, with markets in British Columbia and Ontario still bearing the biggest downside risks. Their peak to trough price forecast ranges from down 19% in Ontario and down 16% in British Columbia to down 6% in Alberta and down 5% in Newfoundland and Labrador. Other price measures including average sales, have already exceeded the national peak to trough forecast of down 15%. That's largely because those measures are more volatile than the house price index. They soared higher during the dramatic run-up earlier in the pandemic and responded more quickly to the downturn, as has typically been the case in prior cycles. The dramatic swing in the market since March 2022 is a cyclical event marking the transition out of highly unusual circumstances, including a global pandemic and exceptionally low interest rates. Structurally, the market is sound, though. They say inventories are still historically low, albeit rising modestly, and there are no signs of overbuilding virtually anywhere in the country. And Canada's population has grown the most in generations over the past year, and booming immigration will keep that going over the medium term. So they believe solid fundamentals will come to the fore in 2024 once the market has adjusted to higher interest rates. So the question is, could things heat up to an uncomfortable degree again in the future? Well, they certainly wouldn't rule it out. It's all coming down to the supply response. And on that front, the recent track record for construction has been underwhelming. While home building has picked up in Canada over the past 3 years, housing completions rose by less than 190,000 units in 2019 to roughly 220,000 units in 2021 and 2022, and it was nowhere near high enough to meet the supercharged demand. And they estimate that the housing stock must expand by at least 270,000 units per year by 2025 just to accommodate the growth in households, let alone address the housing affordability crisis in many Canadian cities. And needless to say, home building needs to ramp up considerably from that point, but it's unclear whether the construction industry has the capacity to do so in the face of significant labour shortages. And so you can see here the same forces at work in Canada as in Australia. We have home prices easing as interest rates are rising. We have an expectation of higher rates for longer. We have expectations of further home price falls and also significantly increased migration and therefore demand for property pulling the other way. But I think RBC has it right. Further falls first and then sort of going sideways, and then a very slow recovery into the medium term. This is certainly not going to be a V-shaped recovery. We're not going to see interest rates cut back down to the pandemic lows. And that means, of course, that housing affordability is going to remain a real problem for many households. And of course, they didn't mention, but perhaps should, that real wages are still going backwards, both in Canada and Australia. And that means that housing affordability is also being crimped by just pure cash flow issues. So this is quite an important reminder that the cycle we're in at the moment is not going to recover and magically come back to where we were a couple of years ago. And so the property bulls who are spruiking, we've hit the bottom and everything's going to be fine, are just smoking hopium. The truth is, this journey is going to be a long, slow grind, with rate cuts not coming in until some way down the track, but also rate cuts not coming anywhere close to the lows of the past few years. So property bulls, you have been warned. You're in for a very bumpy bear ride. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.